Hey there, welcome to the live stream. I'm Mitch, your host. Be the boss of your money. It's an exciting day. The stock market was up again today, but it's not so much because of that. I don't like to make a big deal. The market's up, whatever. The market goes up, market goes down. It does what it does over a short term basis. I don't get excited about that. Maybe I should talk about, you know, what I don't get excited about and what I do. And that could be suggestive to some of you, but get your minds out of the gutter. We're not talking about that. We are looking at things like, if I make an investment, if I accumulate some cash and I put it into something that earns a higher interest rate, if there's an investment I like a lot and it goes down in value and I add to it, that I think is fun. I don't look at the market going up or down as good or bad. I can't stand it when the market goes down and somebody says to me, "Oh, so the market was down today. Oh, you must have had a horrible day." It's like I think they're the one who had a horrible day, and they're just trying to figure out a way to see if they could get someone else to have a horrible day with them, because that's human nature, I guess, right? Whatever. Not us, not you and I. I don't think you'd be watching this if you were like that, because this show is not about the stock of the day. If you want that, you could watch CNBC. I'm not against that. I write a lot of content for CNBC, but it's this show is more about perspective. It's about financial education. It's about giving you, I guess I'll say, coping skills with the market. It's about helping you understand what the market does, why it does what it does, market mechanics, things like that. Because if I can educate you on these important things, you are more likely to stick with the stock market in bad times so that you could make money, so your investments could compound and grow in good times. Now, that makes a lot of sense. We all know intellectually markets go up and markets go down, but we don't make good reactions. We don't have good reactions to stress because our senses go out the window. This is why it's very hard to manage your own money. This is why it's important to have a professional on the sideline, an accountability partner, somebody to remind you, to throw back in your face that you said you were going to hold on in the next bear market. You said you were going to hold on the next time the market goes down. You said you were going to buy more. You said you were going to buy every month nonstop and keep buying. I have clients who send in money every month, and we invest in the market. We invest in bonds and stocks, exchange traded funds, what have you. It's not all about individual stocks. A lot of my clients have portfolios that are exclusively exchange traded funds, ETFs. And what I'm here to do is remind them of why they're doing it. And people will ask me once in a while, should I stop? Should I wait? Should I, keep doing this? Maybe I'll take a break for a little while and watch the market go lower. And everyone who's done that in the last couple of months has seen the market go higher, not lower. Waiting for the Sunday punch, the ultimate best time to get in, it's a sucker's game. You might get it right once out of a million attempts. That's how low the odds are of getting that right. You're better off not just buying, but buying and waiting, buying and holding. If you're looking for quality, now some of you, I get it. You're looking to jump on GameStop for a quick jump or some tech stock for a quick jump. I get that, and we could talk about that. But I don't want the show to be about that, because there are plenty of other outlets that you could go to for that kind of thing. I want perspective. I want to give you perspective. I'm a financial advisor. If you didn't know this, for over 30 years, I've seen clients overcome financial challenges. I've helped clients overcome financial challenges. So I bring all of that experience to bear to my clients. And if you're interested in taking this conversation to a one-on-one to see if you'd be a good fit and to be my client and I'd be a good fit to be your financial advisor, you can always check me out. Check out clientfirststrategy.com. My contact information is there, and you are welcome to give me a call, and we could take this to a one-on-one and get started. My number's on the bottom of the scroll down here. See that here? It's right there, right there, right there, right there. Okay. So if you're probably wondering what this stuff is, I bought some new XLR cables. These are the cables that get attached to the mic. So these are audio cables. Needed longer ones. We're talking about my live stream. I ordered a 6-foot USB-C to USB-A. I got a substantially shorter one, so this is basically worthless. It's not even worth my time to try to return it. So what can I tell you? B&H, I think you messed up that one because the confirmation order even said 6 feet, not that little thing. So somebody threw something into a package here and it didn't come out right, but that's okay. Anyway, let me just roll a quick intro with disclaimers, and we'll get into the heart of the matter, which is inflation, lowest in 2 years. I want to talk to you a little bit about China and inflation globally is actually going down. It's a big freaking deal. Here we go. All right, we're back. That was annoying. Oh, I don't even have camera 2 on. I'm switching to camera 2. That's why it was a black screen. All right, we don't need it. Not a big deal. Just for production quality. First of all, I want to talk to you about the big story of the day. Inflation is the lowest it's been since the beginning of 2021. That's a very big deal. You know, about a year ago or so, inflation was over 9% on the consumer price index. That was a really big spooky number, and people predicting all kinds of bad things and saying that this is stagflation. Remember 1980, 81, 82, how high inflation was, late 70s. And we're going back to that. We're just going to go right back to those horrible times. And at the same time, energy went up a lot, oil went up a lot, and Chevron stock, ExxonMobil stock were going up a lot. And yet people out of the woodwork coming out and saying, oh, now, you know, oil's going to go to 150, 175, the next guy's 200, the next guy's 250. And they're just like one-upping themselves. I have no idea what, you know, like, what for? Like, what are they basing these outlandish predictions on? You know, it's when there's times of stress, either stocks way up or way down, or something with inflation or something massive. In times of stress, that's when the outliers get a lot of attention. That's when the media is looking for professionals who have really strong views of massive moves of commodities or investments or interest rates. So times, you know, when if the market plunged today, you would have people all over the media, the networks, you know, CNBC in particular, saying, "Oh, now we think it's going to go down here, and this is going to be really bad." And if the market went up 2,000 points today, you'd have people saying, "That's because the economy is doing better. We're going to avoid the recession. Interest rates are coming down, inflation's coming down. It's a perfect Goldilocks environment for stocks. Unemployment is holding steady." And so I don't like getting too into outliers. It's not helpful. This becomes a game of possibilities. And I hate that expression, the possibilities are endless, because no, the possibilities are not endless. Let's focus on what's probable, not just possible. It's possible that the United States gets struck by a meteor. It's possible, right? It's possible that you win the Powerball. It's possible, right? It's possible that you get struck by lightning in a stairwell while you're fighting a polar bear, which is actually higher odds than winning the lottery. Okay. So, which brings me back to probability. You know, People have a way of bringing up possibilities that sound like they're likely, that sound like they're real probabilities. And that's where the outliers come in. And I really want to bang this over your head with this, that don't go by what the outliers say. We're going to hell in a handbasket, or we're going to the moon. It's usually something in between. And over the long term, moves in markets, in real estate, in anything, they might have short term big moves. Like people, I know someone's going to say, well, look at the value of my house has gone up like 50% in the last, 2, 3 years. But though that's a short move, that's a very short move. It's a very short term move in the world of real estate. But it doesn't mean we're going to get that every year. And it means that the price of housing could actually be kind of flat now for many years to come to compensate for that. All right. There's something called regression to the mean. Investments typically go up at a certain rate over the long term. And when they're way higher than those returns or way lower than those returns, ultimately, as time goes on, they will be pulled back to the middle, regression to the mean. I would say regression to the mean is the most powerful force in finance, maybe even more powerful than compounding. That's a bold thing to say, right? I mean, didn't Albert Einstein say that compounding is the most powerful force in nature? I don't know if he really said that or not, but people love to quote him on that. People love to find a quote and then attribute it to Warren Buffett or Albert Einstein, because then they feel like they're right and they said something that was smart. And like, who's going to argue with Albert or Warren, right? You can't argue with them. They're so smart, right? So people make stuff up. Stop doing that, all right? I like when somebody makes like a really funny meme and then attributes it to like Albert Einstein or some other, some philosopher. It's so funny when people do that. So I want to get into VIX. Before you get to the VIX, a friend of mine asked me about that. Let's get into inflation a little bit more. Inflation in India, in China, in other parts of the world, in Europe, it's coming down a lot. Now, sure, inflation could stop going down and go right back up. And there's an endless stream of analysts who are saying we're not out of the woods yet. We could have sticky inflation, higher inflation. But I'm looking at the tea leaves, and I've been saying for a while that we should see new highs this year in the major averages, in particular the S&P 500. I have to say, you can't invest directly into an index, but you have to. But you could invest in a security that tracks or mimics an index. But we could see new highs, because if inflation comes down, doesn't necessarily mean that the Fed's going to lower interest rates. But it's not so much that low interest rates or higher interest rates are a game changer. I mean, they're important. Don't get me wrong. I'm not undervaluing the values of those things. But what I'm saying is, what the market really values is stability. Ultimately, corporations, the economy will get used to 5% interest rates. Ultimately, it takes a little bit of time, and that's what causes disruptions. I mean, that's what causes corrections. The market goes down. We go into a bear market, which we did have. But then we get used to it. But as long as we can expect rates to stay the same, that is actually very good for the market. I think that's even better than lower rates. Okay, one of the reasons the stock market has done so well recently in recent years is because, yes, rates were very low. There was zero, but they were steady. They were steadily at that rate. If interest rates were steadily at 2% or 3%, we still would have had a decent market the last 15 years. So that's my point. I'm sticking with it. So the VIX. The VIX is something I follow, and you hear about it a lot. The VIX is low, the VIX is high. The volatility index is called the VIX. And when volatility goes up, the VIX goes up. When volatility in the stock market goes down, the short-term ups and downs is volatility. When volatility goes down, the VIX goes down. I don't think the VIX is any more of a useful indicator than just the general market. Let me explain that. The VIX, and if I had a friend in my office today, he said, Mitch, I love your Charlottesville all the time, but what is the VIX? I said, you mean the VIX? He said, yeah, what's the VIX? The VIX is basically prices, derivatives, options, that sort of thing, that large investors would use to hedge their portfolios. And when they're nervous, they start buying hedges. And because of that demand, the hedges go up in price, which is reflected in a rising VIX. So it just means what are investors willing to pay to protect their portfolios. Most people do not buy derivatives to protect their portfolios. I don't think most people actually need to do it. I think if you invest the right way based on your time horizon, your goals, your risk tolerance, that is your hedge. In my opinion, that's your hedge. You don't need to actually buy something else to hedge your exposure. Okay. So let's think of it this way. You could tell if the stock market's volatile by the daily stock market performance. If you have these up 1,000 point days, down 2,000 point days, up 2,000 point days, just you have these markets that are all over the place. Well, you could tell the market is volatile. And people are like afraid of volatility. You hear the pundits say, "Oh, it's so volatile. I would wait till it comes down. The market is volatile." So what? Stocks are volatile. Stocks trade up and down. The market is a volatile place. The stock market is subject to large downswings without warning. And often we don't even know why it happens until years pass by. We like to assign a reason to every little micro move in the market, but often we don't really know what was behind it. Sometimes I hear people come up with a reason for a move, and then I'm like, that didn't happen. I don't know why they're saying that. They kind of say something that doesn't mean anything, but it sounds good. It sounds like the kind of thing that you would see a pundit say on TV. So it's like you say, "Oh, that sounds good. That must be why." But then you walk away and you think, it doesn't mean anything. Like, what the hell? It's worthless. So, yeah, look, I'm not in a foul mood today. I'm just giving it to you straight. You come here for honesty, and that's what you're going to get. I'm putting my effort into the show, so I'm going to, God damn it, I'm going to give you good stuff. I'm going to enjoy it too. Okay. While you're watching this, if you don't mind giving me a thumbs up or a heart or a wow reaction, depending on which social media platform you're watching on, I really appreciate it. It does help the algorithms. It spreads the good word and it lets me know who's watching, and it lets me know that I'm talking about something that you are interested in. If you have any questions, ask me in the comments. We have my friend Joanne. Hey, Mitch, listened to yesterday's show earlier today. Sure glad to hear some good news for a change. And as always, the sound guidance and explanations you provide to your listeners regarding the market and finance. Thank you so much, Joanne. That is a really nice compliment. You just made my day. So the good news yesterday, if you missed it, is this. The rally that's been led, which you've heard so much about, just by a small handful of massive technology stocks, the usual, the Microsoft, Apple, which hit a new high yesterday, NVIDIA. It's spreading out to industrials, which are right at their year high. It's spreading out to discretionary. It's spreading to drug stocks. Even bank stocks are doing better. Even regional bank stocks are doing better. So we're starting. It shows you that there's a lot of energy behind this rally in the market. And the energy was reinforced today because the inflation numbers came in low, 4%. I know 4% doesn't sound like crazy low when we're used to 2 or 3% or 1% or 0%. But think about the direction we're heading in. And now stats out of China, out of India, out of Europe are showing lower inflation. That means central banks around the world, not only could they stand pat from raising rates, but they could start cutting. As a matter of fact, China cut a short-term rate today. China. So that brings me to China, and then I'll end it on that. Why would China cut a short-term rate if you're supposed to have this China reopening boom after COVID? Because there is no boom. Simple as that. China is not the place to be. In the late 90s and early 2000s, even the mid 2000s, like 2005 to 2010, it used to be if a company doesn't have a China strategy, we don't want that stock. We don't want the company. We don't want to be involved. It's different now. Now, if a company doesn't have a reshoring strategy to bring their production capacity back to the US, or at least back to a friendly nation, which are really the beneficiaries of this are Mexico and Vietnam, and to a smaller extent Canada, but mostly the US, then that's what we want. We don't want a China strategy. We also want an AI strategy, but I have my own views on artificial intelligence. Overall, I think it's a good thing, and I don't really want to get caught up in the multitude of AI stocks, AI software. What I really want to do is I want to be invested in the companies, just like companies use the internet to maximize profits and efficiency. I want to be in companies that maximize AI to maximize their profits. Okay, and maybe it's Costco, maybe it's Target, maybe it's hotel chains. We'll see. But when you have a giant tectonic new technology like AI, something so vast, something that has so much potential, it's going to cause some of today's greatest, most successful companies to lag. And it's going to allow new companies, startups, smaller companies to take a massive leap ahead of the competition. And we're going to see how this shakes out. We're going to see what happens with the stocks that investors are exposed to and the stocks that investors should become exposed to. This is what happens when you have a massive technological breakthrough. And I think AI is big enough to cause that. And that to me is a bigger risk than the inflation buzz or China or Russia. Okay, is AI. And you could just invest in an index fund, by the way, and you'll eventually catch the big winners by doing that. So there's lots of ways to do this. You don't just have to be in individual stocks. Why is China not having a boom? It's because their population is so old now. Their population has shrunk by like 300 million people in the last 2 decades or so. Where did all these people go? Well, they died, but they're not being replaced. You see, they're not having babies. It's too late. If every guy and girl in China started having babies, still wouldn't be enough babies to help lift the population of China. And the problem with a shrinking population is even when you come out of the COVID pandemic and you think you have this post-COVID boom, there are too few people to spend money. You have fewer people, and you have the expense of a country of 1.2 billion people falling in the lap of a country of only, like, let's say 900 million people. So that 900 million people has to pay more per person to support the country because the country is built on a chassis of 1.3 or 1.2 billion. That's a problem. That's a problem with the shrinking population. People are not incentivized to have kids in China. They want to live in the city. It's very expensive. And if you want to have a kid, you probably will live like crap. And it just, it's not a great environment or atmosphere to raise a family in a lot of parts of China, especially in the cities where the population is migrated to. Farming is a much smaller part of the society, which means people typically have less kids in a society that becomes more industrialized. The other thing for China is their economy was led by stimulus, government spending to build roads, projects, public works projects. They're not doing as much of that stuff anymore. So, so China doesn't really have a consumer economy like the U.S. They have a government spending-led economy. So they have a lot less going for them. So I don't think China ever regains the prominence it had pre-pandemic to the manufacturer of the world. I don't think it ever happens again. So for all those out there who think I'm just going to buy a cheap, China stocks are cheap and the whole world's going to go back to normal and China's going to take off. No, I don't think the whole world goes back to normal. The whole world goes back to something. And if you want to call it normal or not normal, you could label it any way you want. But I think that's a risk that people are taking. And I don't think China is the future driver of earnings and global economic growth anymore. Who's it going to be? We'll see. But I could tell you every cycle is different. Every cycle brings new entrants, new players, new winners, and the incumbents get knocked on their rear ends. And most people will fight that and hang on to the incumbents because it's a change to the way of your life, to the way of life, to your way of life. It's a painful thing to go through, but it's necessary, and you might as well embrace it because it's going to happen, and it's happening now. So be nimble, be flexible. You don't have to be ingenious. You don't have to be. You don't have to have great foresight. You don't have to have incredible vision of the future. You just have to realize that the world is different. There are plenty of ways to invest, plenty of ways to be diversified, which is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Okay. So I hope you enjoyed this and found it informative. If you did, definitely like it, share it, maybe subscribe to my YouTube channel, Client First Strategy. And I'm going to let you go and take care of a couple of things this afternoon and then go home. Have a great night. Thank you.